What if the greatest technology story of our generation is also the most expensive mistake investors have ever made? Right now, close to $1 trillion is being funneled into artificial intelligence, into startups with no revenue, data centers the size of small towns, and chips selling for the price of luxury cars. The believers say this is the birth of a new economy. The skeptics say we've seen this movie before and it ends with a crash. So which is it? Today, we're putting the AI boom under a microscope, and the answer is more unsettling than either side wants to admit. Let's start with the sheer scale of what's happening, because the numbers are genuinely staggering. In 2023 alone, global AI investment hit roughly $92 billion, according to Stanford's AI Index report.
Private AI investment has grown more than eightfold over the past decade. Venture capital firms that once agonized over $10 million checks are now writing $100 million ones for companies that are, in some cases, little more than a founding team and a compelling demo. And that's just the startups. The real money, the tectonic money, is flowing into infrastructure. Microsoft, Google, Amazon, and Meta, the so-called hyperscalers, are collectively committing hundreds of billions of dollars to data centers, power contracts, and specialized chips. Goldman Sachs estimates that around $1 trillion is being poured into AI infrastructure over the coming years. To put that in perspective, that's more than the annual GDP of most countries on Earth, wagered on a single technological thesis. And at the center of it all sits NVIDIA, the chip maker whose market capitalization blew past $3 trillion in mid-2024, at one point trading at a price-to-earnings ratio above 70. Now, if you've studied market history, that number should make the hair on your neck stand up, because valuations like that have appeared before, and they've rarely ended quietly. History doesn't repeat, but it rhymes, and right now, the rhyme scheme is uncomfortably familiar. Cast your mind back to the late 1990s. The internet was going to change everything, and here's the twist. It did. The internet absolutely transformed commerce, communication, and culture. But that didn't stop the Nasdaq from becoming a bonfire of capital. Between 1995 and 2000, the index rose roughly 400%. Propelled by companies whose business plans were essentially a .com suffix and a dream. Then, gravity reasserted itself. By October 2002, the Nasdaq had shed nearly 78% of its value. Trillions in paper wealth evaporated. Pension funds bled. Retail investors who bought at the top waited 15 years just to break even. The crucial lesson of the .com era isn't that the technology was fake. It's that a real revolution and a speculative bubble can coexist. Amazon survived the crash, Pets.com did not. And it's not the only precedent. The crypto boom of 2021 followed the same choreography. A genuinely novel technology, a flood of momentum-driven money, valuations untethered from cash flow, and then a brutal repricing that wiped out roughly $2 trillion in market value. The pattern is always the same. The narrative arrives first. The revenue is supposed to follow. Sometimes it does. Often, it doesn't arrive fast enough to save the people who paid peak prices for the story. Now, in fairness, let's give the optimists the floor, because their argument is stronger than skeptics like to admit. First, the companies leading this boom are nothing like the profitless .coms of 1999. Microsoft, Google, Nvidia, and Meta are among the most profitable enterprises in human history, sitting on fortress balance sheets and generating oceans of free cash flow. They're funding AI expansion largely out of earnings, not debt or dilution. Second, unlike many bubble-era darlings, there is real revenue here. Nvidia isn't a story stock. It's selling every chip it can manufacture, with data center revenue growing at triple-digit rates. That 70 times earnings multiple, it compressed quickly precisely because earnings exploded upward to meet it. Third, bulls argue that AI is a general-purpose technology, in the same category as electricity or the internet, something that eventually touches every industry and every workflow. If AI delivers even a modest, sustained boost to global productivity, the math changes entirely. $1 trillion of infrastructure spending stops looking reckless and starts looking like the railroads of the 21st century.
And here's the strategic wrinkle. For the hyperscalers, this may be a game they can't afford to sit out. As several tech executives have put it, the risk of underinvesting in AI is greater than the risk of overinvesting. Losing the AI race could mean losing the next 2 decades. Under that logic, massive capex isn't speculation, it's insurance. But now let's flip the coin, because the bear case cuts deep, and it starts with a simple question. Where is the money actually coming back from?
In June 2024, Goldman Sachs published a research note with a title that says it all. Gen AI. Too much spend, too little benefit? Their analysts questioned whether the $1 trillion flowing into AI infrastructure would ever generate adequate returns, arguing that AI would need to power a genuine productivity revolution, not incremental gains, but a transformation to justify current valuations. And on the ground, that transformation is proving elusive. A 2024 McKinsey Global Survey found that only about 5% of companies reported meaningful, measurable bottom-line impact from their generative AI deployments. 5%. Think about that gap. Near universal hype at the top of the market, single-digit realized value at the bottom of the income statement. That is the anatomy of a narrative outrunning its fundamentals.
Then there's the behavioural evidence. Surveys from FINRA's Investor Education Foundation in 2023 and 2024 found that many retail investors were buying AI-linked ETFs based primarily on momentum, because prices were rising, rather than any analysis of earnings. Economist Robert Shiller has a name for this in irrational exuberance, the greater fool dynamic. You buy not because the asset is worth the price, but because you believe someone else will pay more. Every historic bubble, from tulips to telecoms, has run on that fuel. And there's one more structural fragility worth naming: circularity. A remarkable share of AI revenue is big tech paying other big tech. NVIDIA's earnings depend heavily on a handful of hyperscalers, whose spending depends on AI demand that, for now, remains largely aspirational. If even one major player blinks and trims its capital expenditure guidance, the shockwave travels through the entire ecosystem at once. So how would you actually see a correction coming? Not from headlines, from a specific set of gauges. Watch hyperscaler capex guidance like a hawk. Right now, Microsoft, Google, Amazon, and Meta are the load-bearing walls of the AI economy. The moment one of them signals a slowdown in data center spending, the market's entire revenue assumption gets stress-tested in real time. Watch the gap between valuation and revenue. When companies trade at 50 or 100 times sales, not earnings, sales, the market is pricing in flawless execution for a decade. Any stumble becomes catastrophic. Watch enterprise adoption numbers. If that McKinsey 5% figure starts climbing meaningfully, 15, 20, 30% of companies reporting real bottom-line impact, the bull case gains a spine. If it stagnates while spending accelerates, the disconnect widens toward a breaking point. Watch market concentration. When a handful of AI-linked stocks account for the majority of an entire index's gains, as they have recently, the market isn't diversified. It's a single bet wearing a disguise. And finally, watch your own behavior. When you find yourself buying because prices went up yesterday rather than because you understand what you own, you've become the liquidity for someone else's exit. So, is AI a bubble? Here's the honest, unsatisfying, historically grounded answer. It can be both a genuine revolution and a dangerous overvaluation at the same time.
The internet was real, and the dot-com crash still destroyed fortunes. The technology's importance was never the question, the price paid for it was. AI is almost certainly going to reshape the economy over the next 20 years, but markets don't reward being right about technology. They reward being right about technology at the right price. The dot-com survivors weren't the loudest companies of 1999. They were the ones with real cash flow when the music stopped. For investors, the playbook writes itself. Stay diversified. Be ruthless about the difference between revenue and narrative. Size positions so that a 50% drawdown in AI stocks wounds you but doesn't end you. And remember that missing the top of a bubble has never bankrupted anyone, but buying it has. The trillion-dollar question isn't whether AI changes the world. It's whether the world changes fast enough to justify the check that's already been written. History suggests the technology usually wins. The investors who overpay for it usually don't.